What if I told you that investing was not just for Wall Street elites in expensive suits, but for everyday people like you and me? What if the secret to building wealth was not hidden in complex formulas, but right in front of us? In the stores we shop at, the restaurants we eat at, and the products we use every day? Welcome to FinSumm. Today we are diving into Learn to Earn by Peter Lynch and John Rothschild, a book that completely changes how you think about money, business, and investing. Now, who is Peter Lynch? Picture this: a regular guy from Boston who became one of the most successful investors in history. He managed the Magellan Fund and turned $20 million into $14 billion over 13 years. But here's what makes Lynch special. He didn't use insider secrets or complicated strategies. He used common sense and everyday observation that anyone can understand. This book has one simple purpose: to teach everyday people like us how the economy works, how businesses operate, and how to start investing wisely. And here's why this matters more than ever. Understanding money and investing is not optional anymore. It's essential for building long-term wealth and securing your financial future. Whether you are a student in California, a teacher in Mexico City, or an engineer in Canada, the principles in this book can change your financial life. So let's begin this journey together. Part 1. Why you should understand business and investing. Here's something that will blow your mind. Most people spend their entire lives working for companies, yet they never learn how companies actually work or grow. It's like being a football player who does not understand the rules of the game. Peter Lynch makes a brilliant point. Business is literally all around us. The coffee you drink in the morning? That's business. The phone you are listening to this on? That's business. The streaming service you use to watch movies? That's business. Yet, most of us treat these companies like mysterious black boxes. But here's Lynch's revolutionary idea. Investing is not about speculation or gambling. It's about owning a piece of a business. And everyone can understand the stock market if they take the time to observe and learn. Let me give you an analogy that makes this crystal clear. Imagine there's a fantastic pizza shop in your neighborhood. The owner is getting older and wants to retire, so he offers to sell you a 10% stake in his business. Before you decide, what would you want to know? You would probably ask, how many customers come in daily? Are they making a profit? Is the pizza actually good? Are there too many competitors nearby? This is exactly what buying shares in a company is like. You are becoming a partial owner in that pizza shop. If the shop grows and serves more customers, you profit. If it struggles, you lose money. It's that simple. The beautiful thing is, you can observe businesses everywhere. That new coffee chain that always has long lines? That might be worth investigating. The retail store that's always empty while its competitor is packed? That tells you something important about which business is thriving. Lynch's key lesson here is profound. Knowing how companies succeed helps you choose the right ones to invest in. You don't need a finance degree. You need curiosity and common sense. Part 2. A short history of capitalism and business in America. Now, let's take a quick journey through time to understand how we got to where we are today. Don't worry, this is not a boring history lesson. It's the story of how regular people like us got the opportunity to build wealth through investing. Picture America in the 1800s, mostly farms and small towns. Then came the Industrial Revolution, and suddenly, everything changed. Factories started mass-producing goods that previously took craftsmen hours to make by hand. This was not just about making things faster, it was about making life better for everyone. Then Henry Ford revolutionized everything with the assembly line. Imagine this. Before Ford, cars were luxury items only the wealthy could afford. Ford's innovation made cars affordable for his own factory workers. That's the power of smart business. creating products that improve lives while building wealth. But here's where it gets really interesting for us as potential investors. As these companies grew bigger, they needed more money to expand. They could not just rely on one wealthy owner anymore. So they created something brilliant: the stock market. This allowed regular people to pool their money together and own pieces of these amazing businesses. Think about it. Financial institutions, credit systems, and public corporations all developed to help businesses grow faster and let ordinary people participate in that growth. The stock market became the great equalizer, a place where a teacher from Tokyo could own the same slice of a successful company as a banker from New York. The key insight here is that capitalism rewards innovation, and investing lets you be part of that innovation. Every time you buy a share of a company, you are betting on human creativity and progress. Lynch's lesson is clear. Understanding this economic history makes investing feel less mysterious and more logical. You are not just buying numbers on a screen. You are participating in the greatest wealth creation system in human history. Part 3. What is a company? Really? Let's get to the heart of the matter. What makes a company valuable? This might seem like a complex question, but Lynch breaks it down beautifully. A company is valuable based on 4 simple things: how much money it brings in revenue, how much profit it keeps after expenses, what assets it owns, and how much of the market it controls. That's it. No mystery, no magic, just basic business logic. Now, you will hear scary-sounding terms like earnings, dividends, PE ratio, and equity. But Lynch explains these in ways anyone can understand. Let's go back to our lemonade stand analogy. Imagine 2 kids on your street. Both run lemonade stands. Kid A sells $50 worth of lemonade and spends $30 on ingredients and supplies, making $20 profit. Kid B sells $40 worth but only spends $15, also making $25 profit. Who has the better business? Kid B, right? They're more efficient. This is exactly how you evaluate companies. Earnings are simply profits, how much money the company keeps after paying all its bills. Some companies share these profits with shareholders through dividends, like getting a bonus for being an owner. The PE ratio, price to earnings, is just a way to see if a stock is expensive or cheap. If that lemonade stand Kid B wants to sell for $250 and they make $25 profit per year, that's a PE of 10. It would take 10 years to earn back your investment if profits stayed the same. Is that reasonable? That depends on whether you think the business will grow. Here's Lynch's crucial insight. A stock is not just a number on a screen that goes up and down randomly. It's a claim on future earnings. When you buy stock, you are saying, I believe this company will make money in the future, and I want my share of those profits. The lesson is simple. Good investors think like business owners, not traders. They ask, is this a good business? Not, will this stock price go up tomorrow? Part 4. What is the stock market? The stock market sounds intimidating, but Lynch strips away the mystery. It's simply a marketplace where shares of companies are bought and sold, just like a farmer's market where people buy and sell vegetables. But what makes stock prices move up and down? Lynch identifies 2 key forces, and understanding these will change how you view investing forever. First, there are earnings, the actual profits a company makes. If our pizza shop starts making twice as much profit, logic says it should be worth more. This is the rational, business-focused side of the market. Second, there's perception. What investors believe will happen in the future. Sometimes people get excited about a company and push its price way above what the business is actually worth. Other times, they get scared and push the price way below its true value. This is the emotional, often irrational side of the market. Here's a perfect example. Imagine a fantastic restaurant that's been packed every night for months. The earnings are strong. That's reality. But then rumors spread that a competitor is opening next door. Even though nothing has actually happened yet, investors might panic and sell their shares, driving down the price. That's perception overriding reality. Lynch's brilliant insight is that short-term volatility, those daily ups and downs, does not always reflect long-term value. The market can be irrational in the short term, but over time, stock prices tend to follow company performance. Think of it like this. If you owned that packed restaurant, would you sell it just because people were spreading rumors? Of course not. You would focus on serving great food and building your business. That's exactly how Lynch thinks about stocks. This creates opportunities for smart investors. When the market panics about a good company, you might get to buy shares at a discount. When everyone gets too excited about a mediocre company, you know to stay away. The key lesson: don't treat the stock market like a casino where you are betting on random outcomes. It's a marketplace for ownership in real businesses with real customers, real products, and real profits. Part 5. How to think like an investor. Here's where Peter Lynch's approach becomes truly revolutionary. He didn't find his best investments by studying complex charts or listening to Wall Street analysts. He found them by simply observing the world around him with an investor's eye. Picture this. Lynch is walking through a mall with his family. His wife shops at the Gap and loves their clothes. His daughters are obsessed with their products. He notices the store is always busy. The item quality is good, and customers keep coming back. So he investigates the company's finances, likes what he sees, and invests. The Gap becomes one of his most successful picks. Or consider Dunkin' Donuts. Lynch didn't discover it through a fancy research report. He noticed that every morning there were long lines of people eagerly buying coffee and donuts. The business model was simple. The profit margins were good, and people seemed genuinely loyal to the brand. This is what Lynch calls investing in what you know. You have insights that Wall Street analysts sitting in offices might miss. You know which restaurants are always busy, which stores have great customer service, which products your friends can't stop talking about. But Lynch is not suggesting you blindly invest in every company you like. He teaches you to look for specific qualities. Strong fundamentals. Is the company actually making money and growing? Real-world relevance. Do people genuinely need or want what this company offers? Competitive advantages. What makes this company special compared to its competitors? Here's a crucial warning Lynch gives. Don't confuse popularity with profitability. Just because a product is trendy doesn't mean the company behind it is a good investment. Remember those fidget spinners that were everywhere for a few months? Popularity faded quickly, and so did the profits. The beauty of Lynch's approach is that it turns everyday life into research opportunities. That new app everyone's using? That restaurant chain expanding to new cities? That product that solved a real problem in your life? These could all be investment opportunities waiting to be discovered. Lynch's lesson is empowering. Use your common sense as a consumer to find good investments. You have more knowledge than you realize. You just need to start thinking like an owner, not just a customer. Part 6. Investing versus speculating. Here's where Lynch draws a line that could make or break your financial future. The difference between investing and speculating. Speculators are like gamblers at a casino. They chase stock prices, hoping to get rich quick. They buy a stock because it went up yesterday, hoping it will go up again tomorrow. They trade constantly, trying to time the market perfectly. They focus on price movements, not business performance. Investors are completely different. They analyze businesses and expect long-term gains. They buy a stock because they believe the underlying company will be more valuable in the future. They are patient, disciplined, and focused on fundamentals, not day-to-day price swings. Let me give you a perfect example. Imagine two people both discover a fantastic local bakery that's expanding rapidly. The speculator might buy shares and then check the stock price 10 times a day, getting excited when it goes up and panicking when it goes down. After a few weeks of volatility, they might sell, hoping to find the next hot stock. The investor takes a completely different approach. They research the bakery's expansion plans, study their profit margins, and understand their competitive advantages. Then they buy shares and wait. They let the business grow, reinvest profits, and expand to new locations. 5 years later, they might have made 10 times their money. Lynch urges patience because the numbers don't lie. Long-term investing consistently outperforms market timing. Studies show that trying to jump in and out of the market usually results in buying high and selling low. Exactly the opposite of what you want to do. Here's a powerful example. Holding one great stock for 10 years often beats flipping 20 average ones in a year. Why? Because great companies compound their growth over time, and you avoid the transaction costs and tax implications of constant trading. Lynch's lesson is fundamental. Building wealth is a marathon, not a sprint. The tortoise doesn't just beat the hare in fairy tales, it beats the hare in investing, too. Part 7. Tools for evaluating stocks. Now, let's get practical. Lynch breaks down the key tools that help beginners assess potential investments. Don't worry. These are not complicated formulas that require an advanced degree. They are simple concepts that anyone can understand and apply. First, the PE ratio, or price-to-earnings ratio. This tells you if a stock is expensive or cheap relative to its profits. Remember our lemonade stand example? If the stand makes $25 profit per year and someone wants to sell it for $250, that's a PE of 10. If they want $500 for the same business, that's a PE of 20. Which seems like a better deal? The lower PE, assuming the business quality is the same. But here's the key. A low PE is not automatically good, and a high PE is not automatically bad. A fast-growing company might deserve a higher PE because its earnings are increasing rapidly. It's like paying more for a young, energetic racehorse versus an old, tired one. Next, look at earnings growth. Is the company consistently making more money each year? Lynch loves companies that can grow their earnings by 15 to 20 annually for several years. It's like finding that lemonade stand that goes from making $25 profit to $30, then $35, then $40 each year. That's the power of compound growth in action. Debt is another crucial factor. A little debt can help a company grow faster, like taking a mortgage to buy a house. But too much debt can be dangerous, especially if business slows down. Lynch prefers companies with manageable debt levels, enough to fuel growth, but not so much that it keeps management awake at night. Industry position matters enormously. Is this company a leader or a follower in its industry? Leaders usually have advantages that followers don't. Better brand recognition, more resources for research and development, stronger relationships with suppliers and customers. Lynch also emphasizes reading annual reports. I know that sounds boring, but these documents tell you everything about a company's performance, strategy, and challenges. Think of it as getting to know a business before you become a part owner. Let me give you some concrete examples. Retail. Chains like McDonald's or Starbucks are easy to understand. You can visit their locations and see how busy they are. Consumer goods companies like Coca-Cola or Johnson & Johnson make products you use and understand. Tech companies might be trickier to evaluate, but if you use their products daily and see clear value, that's a starting point. Lynch's empowering message. You don't need to be a math genius to evaluate stocks. You just need to be curious and consistent. The tools are simple. Success comes from applying them thoughtfully over time. Part 8. The psychology of the investor. Here's something that might surprise you. According to Peter Lynch, the biggest threat to your investment portfolio is not market crashes, economic recessions, or company failures. It's your own emotions. Lynch famously said, "The key organ in your body for investing is not your brain, it's your stomach." What he means is that investing success depends more on your ability to stay calm under pressure than your ability to analyze financial statements. Let me paint a picture of the most common psychological traps that destroy wealth. First, panic selling in a downturn. Imagine you own shares in a great company, and suddenly the market crashes. Your investment drops 30% in a few weeks. Every financial news channel is talking about doom and gloom. Your neighbor tells you he sold everything to cut his losses. What do? Most people panic and sell, locking in their losses. But Lynch would ask, did the underlying business change? Is the company still profitable? Do customers still love their products? If the answers are yes, then the sale price might actually be a buying opportunity, not a reason to sell. Second, getting greedy in a bull market. When everything is going up, people start believing they're investing geniuses. They borrow money to buy more stocks, chase the hottest trends, and convince themselves that prices will keep rising forever. This usually ends badly when reality returns. Third, following the crowd. Humans are social creatures. We feel safer doing what everyone else is doing. But in investing, following the crowd often means buying high and selling low. When everyone is excited about a stock, it's probably overpriced. When everyone is scared, there might be great bargains available. Here's a powerful example. During the 2008 financial crisis, many excellent companies saw their stock prices fall dramatically. People who panicked and sold everything missed out on incredible returns over the following decade. Those who stayed calm and even bought more shares during the panic were richly rewarded. Lynch teaches that confidence comes from understanding what you own. If you have done your research and you know why you bought a stock, short-term price movements become much less scary. It's like owning a house. You don't check its value every day and panic if real estate prices fluctuate. The solution Lynch proposes is beautifully simple. Let your plan, not your feelings, guide your actions. Before you buy any stock, decide why you're buying it and under what circumstances you might sell. Write it down. When emotions run high, refer back to your plan. Remember, the stock market transfers money from the impatient to the patient. Your emotions will try to make you impatient. Your discipline needs to keep you focused on the long term. Lynch's lesson is liberating. Discipline beats excitement every time. The most successful investors aren't the most emotional. They are the most consistent. Part 9. The Power of Compound Interest. Einstein allegedly called compound interest the eighth wonder of the world. And Peter Lynch shows us exactly why this matters for every investor, especially young ones. Here's the magic. A dollar invested early does not just grow, it grows exponentially. Thanks to compound returns. Your money makes money, and then that money makes more money, creating a snowball effect that can be absolutely life-changing. Let me give you a real example that will blow your mind. Meet Sarah and Tom, both 25 years old. Sarah decides to invest $2,000 every year for 10 years, then stops completely. Tom waits until he's 35, then invests $2,000 every year for 30 years until retirement. Sarah invests $20,000 total. Tom invests $60,000 total, 3 times more than Sarah, who has more money at retirement, assuming 10% annual returns. Sarah ends up with about $1.3 million. Tom has only about $900,000. Even though Tom invested 3 times more money, Sarah's head start gave her 40% more wealth. That's the incredible power of starting early and letting compound interest work its magic. But it gets even better. Lynch emphasizes reinvesting dividends for maximum growth. Instead of taking dividend payments as cash, you use them to buy more shares. Those additional shares then pay dividends, which buy even more shares. It's like planting seeds that grow into trees, which produce more seeds, which become more trees. Here's another way to think about it. If you can double your money every 7 years, a $10,000 investment becomes $20,000 after 7 years, $40,000 after 14 years, $80,000 after 21 years, and $160,000 after 28 years. You invested $10,000 and ended up with $160,000. That's the magic of compound growth. The key insight Lynch hammers home. Time is the investor's most powerful ally. You can't go back and start investing earlier, but you can start today. Every year you wait is a year of potential compound growth lost forever. This is why Lynch encourages even small, consistent investments. You don't need thousands to begin. You need time and consistency. A young person investing $100 per month can build serious wealth over decades, while someone starting later with larger amounts faces an uphill battle. The lesson is urgent and hopeful. Start now. Invest consistently, and let mathematics work in your favor. Compound interest does not care about your age, education, or background. It rewards everyone who starts early and stays patient. Part 10. Getting started as a young investor. Lynch's final advice is both practical and inspiring. You don't need thousands of dollars or years of experience to begin investing. You need 3 things: a willingness to learn, the discipline to start small, and the patience to think long-term. Here's Lynch's simple roadmap for beginning investors. First, open a brokerage account. This used to be complicated and expensive, but today you can open an account online in minutes, often with no minimum balance and no trading fees. It's easier than opening a bank account. Second, start reading financial news and company reports. This does not mean spending hours every day buried in complicated analysis. Start with 15 to 20 minutes daily reading about companies you are interested in. Follow businesses you admire. Understand what makes them successful. Third, start small and invest consistently. Lynch suggests beginning with companies you understand and use. Maybe it's the smartphone company whose products you love, the coffee chain where you start every morning, or the streaming service you cannot live without. Here's what starting small looks like in practice. Instead of trying to time the perfect moment to invest a large sum, invest a small amount regularly, maybe $50 or $100 every month. This approach, called dollar cost averaging, reduces your risk because you're buying shares at different prices over time. Lynch encourages creating a simple portfolio of companies you understand. Start with 3 to 5 stocks from different industries, maybe one technology company, one consumer goods company, one healthcare company. Don't try to own everything immediately. Most importantly, Lynch emphasizes that learning by doing beats learning by reading. You can study investing theory for years, but nothing teaches you like actually owning stocks and watching how businesses perform over time. Here's his encouragement to young investors. You have something that money cannot buy: time. A 20-year-old who invests consistently has 45 years until retirement for their investments to compound. That's an enormous advantage that older investors would pay anything to have. But don't wait for perfect knowledge or perfect timing. Lynch famously said, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." The lesson is clear and actionable. The best way to learn investing is by doing it. Start today, even if it's small. Start with companies you understand. Stay consistent. Stay patient. Your future self will thank you for every day you start earlier rather than later. Conclusion. As we wrap up our journey through Learn to Earn, let's remember Peter Lynch's revolutionary message. Investing is not a mystery reserved for Wall Street professionals. It's a skill that anyone can learn and master. You don't need to predict the future. You don't need insider information. You don't need complex mathematical formulas or expensive software. You just need to observe the world around you. Think like a business owner and invest in companies that make sense to you. Lynch's approach is beautifully democratic. Whether you are a student in Sao Paulo, a nurse in Nigeria, or an engineer in Estonia, you have the same fundamental tools as any professional investor: your eyes, your brain, and your common sense. Remember the key principles we have covered. Investing is about owning pieces of businesses, not gambling on price movements. Great investment opportunities are often hiding in plain sight around you. Time and compound interest are your most powerful allies. Your emotions are your biggest enemy. Discipline beats excitement every time. Starting small and early beats, waiting for the perfect moment. But here's Lynch's most important insight. The average person can beat the market if they stay informed, stay patient, and stay invested. Professional fund managers have constraints, pressures, and bureaucracies that individual investors don't face. You can hold stocks for decades if you want. You can invest in companies you truly understand and believe in. The stock market is not your enemy. It's your opportunity. Every day you wait is another day that compound interest is not working for you. Every month you delay is another month that great businesses aren't building wealth on your behalf. So here's my challenge to you. Inspired by Lynch's wisdom, start today. Open that brokerage account. Buy one share of a company you admire and understand. Read about their business. Watch how they perform. Learn by doing. Remember, building wealth through investing is not about getting rich quick. It's about getting rich for sure. It's about participating in the greatest wealth creation system in human history. It's about turning your hard-earned money into a team of businesses working to make you financially free. Peter Lynch proved that regular people can achieve extraordinary investment results. The question is not whether you can succeed. It's whether you will start. Your financial future is calling. It's time to answer.